All right. Thank you, James, so much for taking the time. Really, really appreciate it. I think you have the best content in economics. Your newsletter is really, really great. I I learn a lot by reading your newsletter, your Twitter. So I really, really appreciate taking the time. So thank you for coming. I really wanted to,
Well, thank you for having me. Giuliano that's how we say it, right?
Giuliano. Yeah, that's right.
So, we're Americans. We're not as civilized. So, yeah, no, thank you for having me. I'm happy to be here.
Awesome. Thank you so much. All right. I wanted to start with that spiral and talk about, what's happening.
We're gonna go right into it.
Exactly. Yeah. That spiral, it's something that you talk a lot about. And I think you had maybe a year ago, a really nice breakdown of the debt spiral in the US. So what is the debt spiral and what's happening in the US? And is it something that is going to happen no matter what? Or can the US inflate away the debt? So for example, I've heard, for example, New Zealand, maybe Israel, they inflated their debt by printing out maybe 100% of their GDP or something like that. Can can we get away from the debt spiral?
Yeah, that's a good question. I did. I wrote about a year ago, a little over a year ago, just try to get people's attention on it to realize that the U.S. is taking on so much debt that we're in what we're entered. We actually entered what we call a debt spiral. And so, what do I mean by that? Well, if you look at the United States government and kind of break it apart like a company on the New York Stock Exchange, if we were to consider this company, we would call it a zombie company. And the reason is that the United States is not earning enough money through tax receipts. They're actually just taxing our productivity, but we're not earning enough money to pay for the interest payments on that debt. We don't cover that. So why is that? Well, in the United States in particular, and all sovereigns, they have this issue is look, you've got your productivity and you've got your tax return, you've got your tax collections. So productivity is called GDP, right? So, but when the Congress creates their budget, they have certain items that are signed into legislation. These are called mandatory expenses. Okay, so you have things like Social Security, Medicare, Medicaid, and some other programs. And then you've got the military expenses, which are their their long-term contracts. They're not signed into legislation, but they're long-term contracts with defense manufacturers, and they're considered pretty important, as we're going to see in the next few months, possibly even more important, in times of conflict. And so, but they're going to spend a certain amount of money. And then the last thing they've got, the biggest item on their sheets that they have to spend money on, they absolutely must pay the invoices on is the interest on the debt. So those three things add up though to more than the tax collections, which means that deficit, it creates a deficit, and that deficit is growing. And why it's growing is because we're spending more on things like military, Social Security, Medicare, Medicaid. Those expenses are only getting larger as we have inflation, and as the Fed, the Federal Reserve, is raising interest rates in order to try to fight that inflation. Interest rates are going higher. So every time that a bond matures, because we don't make enough money to just pay off the principal of that bond, we have to issue another bond to get the money to pay that back. And by issuing the new bond at a higher interest rate, it creates a larger interest rate bill, the interest rate payments. And so that deficit just grows. And so I liken it to a single parent who is struggling to make ends meet. They're working two or maybe three jobs, which we're seeing a lot of in this country right now. And they can't make ends meet. They've got mandatory expenses. They've got their house payments, their car payments. They've got expenses they've got to pay for food, gas, to get themselves to their jobs. and they've got to feed their children and clothe their children. And so these are kind of mandatory expenses that they can't just avoid. But if their jobs are not paying for those expenses, then they have to take out the obvious choice is to take out a credit card. And eventually they run up that credit card until it's full. And then they have to take out another credit card. And the interest payments on that credit card, the first credit card are now getting put on the second credit card. And then that one gets filled up and they go to a third credit card. And it just gets into this credit cycle where they're in this debt cycle, and it's called a debt spiral. They just can't get out of it. And eventually they go bankrupt. So going back to what you were saying is that, yes, there are countries who have dealt with this and in effect have declared bankruptcy by debasing their currency. They're devaluing that debt by saying that they'll pay 50 cents on the dollar for it, basically. And so the people who are holding that debt, well, they only get half of what they put into it. And now their investment has been cut in half, and it winds up, it's called a reset, and kind of like a debt jubilee. And it's a reset where the debt is no longer worth what it was. And so the people who are holding it wind up getting hurt. And then it normalizes. It gets to a point where all the citizens are back into a different system, and whether it goes through hyperinflation or not, that then you have a whole new standard that you kind of settle to.
Interesting. So, I mean, in terms of the amount of debt and the finances of the country, obviously they are not sustainable the way they are. But I guess there there might be two different views. I think one view that some people hold is that maybe there's hyperinflation whereas basically there is fiat system, the government keeps printing, and inflation basically goes in exponential. But I guess the other view is that maybe there's a path towards where maybe there's a debt jubilee, and sometimes governments don't pay as much, like pay, half of it. In other ways, because this debt is denominated in dollars, you can just print it out, right? And like print, let's say 100% of the GDP or whatever it is, and basically pay out that debt. My question is, like, let's say that the government, like, it has some mandatory expenses, right? But at some point, a president and the Congress and the Senate can all be aligned and say, look, we're not going to spend as much money in Medicare. And so we're going to, you know, maybe they don't want to get reelected. And oh, maybe we have a politician that doesn't want to get reelected and cares about its people. But is it the case that the road for the US is hyperinflation, or can there be a case where we just inflate it away, or, we pay just like half of whatever we owe to the
Yeah,
ones holding?
it's a good question. So first of all, any sovereign, any country that issues debt in its own currency, there's no reason for it to default, right? So because we could always just print more money and buy the debt in order to, in order to monetize the debt and keep the charade going. You just print more money and pay your bills, right? So there's no reason for a country who can print its own money to default. And so the United States is in a different position, right? Because the United States has the benefit of holding the global reserve asset, which is the US Treasury. And by extension, the global reserve currency is the US dollar. So we can keep this charade going for a very long time. And other currencies and other sovereign debts they'll fail before us, and they'll fold into the dollar because of that, as the system stands right now. Now, going back to your question, what can they do though? Because it is getting out of control, and it's so out of control that the the that the Treasury actually they do updates, and they do like a state of the Treasury periodically. And earlier this year, they put out a chart that showed the debt rising exponentially, and the debt to GDP, meaning they know that we're issuing far more debt than we're creating productivity in the United States, which means that we're not going to be able to pay it all off. And so the chart, they subtitled it it was called the State of the Treasury, and they subtitled it an unsustainable fiscal path. And they issued this. This is the U.S. Treasury that issued this. Like, it's mind-boggling, but it's so bad that they're trying to get the attention of Congress. They're trying to get the attention of the politicians. Say, you've got to stop spending. We need to stop spending because we can't keep up with this. We're just going to keep issuing debt. And so, lo and behold, that article I wrote a year ago, over a year ago, just a little over a year ago, was we were, we were at $31.4 trillion of debt, I believe, if I remember correctly. And now you flash forward just over a year, and we're at 33.5. Actually, we were at $30 trillion of debt, 30.7. We're at 33.5 trillion. It is expanded so massively, so quickly, because of what we're talking about, because of the rise in deficits, the rise in interest expense. And so it's just getting bigger and bigger and bigger. Okay, so what can they do? Are they going to default? Are they just going to give us less money for it? They have three options, and you mentioned one of them. The first option is obvious. It's austerity. You cut spending. You cut programs that are unnecessary. You don't send hundreds of billions of dollars overseas to countries, for wars that we can't win, or wars that we shouldn't be involved in, things like that. You just, and without being on either side of morality here, we're spending more money than we have, far more. So what happens is you can either cut that spending, which we know, as you said before, it's political suicide. You won't get reelected because you will upset your constituents, part of your constituents, that and you won't get reelected. So of course that's political suicide. No politician's going to do it. We've never done it. We're not going to do it now. You saw in the debt ceiling crisis, nobody was willing to, step up to the plate, either side, to say, okay, we'll cut spending to make sure that we stay under the debt ceiling. No, what they said was, we just won't have a ceiling for now. We'll revisit it later. And then flash forward to just a few weeks ago, we were in the spot where we didn't really have a budget. And so once again, they kicked that can down the road because nobody wants to cut spending, right? So it's not happening. The second thing you could do is raise taxes, right? So you tax more from that productivity, and you put more money from the citizens' pockets into the government to pay for all the programs that the government's paying is spending money on. But if you do that, eventually it disincentivizes productivity. So companies aren't incentivized to take money and either reinvest it into research and development, new programs, new products, and they hoard it instead, and it lowers productivity in the long run. You get to the same spot, and you have the same amount of deficit. And the third thing they can do is obvious. They can just issue more debt. And that's the obvious thing that they're doing. They're just issuing more debt and papering over the problem by monetizing that debt, printing money, and making sure that in times of stress, when the Treasury market gets what they call disorderly, they'll come in, they'll step in, they'll put money, the Treasury will press a button, money will be deposited on the Fed. The Fed will tell the banks to go buy the debt. They'll buy it from them, and essentially it just goes on the Fed's balance sheet. Okay. So long term, though, can they continue doing this? No, they can't continue doing this, not forever. But what can they do? Well, they can print that money, and they know that if you expand the money supply, it produces what we know as inflation, and it devalues the dollar. So it's called debasing your currency. And so by printing all this money and pushing all this money into the pockets of banks and pushing it out into the nation, what they're doing is they're creating inflation of goods and services, which means that the gross domestic product, the productivity in nominal dollars is going up. They're fake dollars. They've just put more dollars in the system, so it's going up, and they tax those dollars at that higher nominal amount. And then they use those bigger tax dollars to pay down the debt that they issued years ago, which now is worth less. So if I lent you $100 10 years ago, right? And then you pay me that $100 back today, who made out on that trade, right? Because now I have $100 that's worth far less than it was when you borrowed it years and years and years and years ago. So, and that's exactly what they're doing. So what the United States Treasury has to do, what the United States government, the Treasury, the Fed, what they have to do is make sure that we allow for high perpetual inflation that just goes on forever and just keeps this charade going by creating more and more money in the system to tax those dollars and pay down this debt. Now, in reality, we're not going to pay it down. We're just going to try to slow that gap of deficit where it doesn't grow so rapidly that we go into what's called hyperinflation. And what I mean by that is that eventually citizens here and around the world will lose confidence in the US Treasury and the US dollar, and they'll sell it. And that creates what's called hyperinflation. Now, that's not happening yet. It's not going to happen. It's going to take a very long time, in my opinion, because of what we said at the beginning, which is the US has the benefit of being the world reserve asset and currency. So other currencies will fail before we do, and we will swallow them whole. But eventually the music will stop. I don't know when that will happen, but this cannot go on forever.
Yeah, interesting. Yeah, I hope this music ends because I think the consequences of this system are really bad for society. So we have, at the end of the day, a socialist government where they print out money, and I think the consequences are really dire. Like financial assets and real estate, for example, go up like crazy because interest rates are basically not market driven, and then people can't afford homes, and then you end up, with the American dream kind of crushed. But one interesting thing that you mentioned is that the US is like I saw a tweet, I think recently, like the dollar is garbage, but it's the best garbage among all the
Yeah,
garbages
that's
out there.
that's Greg Foss's quote. His quote is, "It's a pile of dirty laundry, and all if you take all sovereign currencies and all fiat sovereign bonds and fiat currencies, you put them in a big pile. The U.S. dollar is the cleanest shirt in that dirty pile." So and that's the truth. Unfortunately, I would say that there's a few of them. The Swiss franc is probably up there. So, but yeah, that's the sad truth. And like you're saying, it hurts everybody, right? It hurts everybody but the wealthiest. So if you do not own assets that are appreciating as we have this inflation, this dramatic inflation, meaning if you don't own a ranch or 10 houses or a few mansions, or, you don't have thousands of ounces of gold, or you don't have, tens of millions of dollars or billions of dollars of stocks, then you're hurt by this because you're not, your assets, if you don't have any, you don't have any to appreciate along with this inflation. All that's happening is that you're working your second, third job in order to try to keep up with the inflation for the things that you need: your gas, your food, your clothes, your house, your rent, your car payments. Like, everything's going up. And so unless unless your wages are keeping up with that rate, which they aren't, they clearly aren't, then you're losing out. And so this inflation game only helps a few people. It only helps the top 1%. It doesn't help the rest of the nation. It doesn't help the rest of the world. And that's the problem. It's oppressive. Inflation is a tax that's oppressive that you just can't get out of.
Interesting. Yeah. So you talked about, the US being the best, and I among all these other currencies are one of the best. I mean, one interesting thing that you mentioned, talked about, I think Japan. Japan seems to be the one that's leading, like the leading indicator of what's about to happen in the West, right? So like the BOJ is basically owns more than 50% of the government bonds of Japan. And like they are starting to see their currency depreciate against even other, currencies like the dollar, because they're printing so much and they can't keep that balance. And I mean, if you look around, like where can you escape? I mean, Europe is also, it's an even worse situation than the US. China has as much debt, or like more debt than the US, and like it doesn't seem healthy. So can you talk a little bit more about Japan and why has it been leading the way in this system compared to the US, and what's happening there, so we can have an idea of what's about to happen in maybe Europe and the US?
Sure. I mean, Japan's a different situation. Let's make this clear. Okay. So Japan had tremendous growth and expansion after World War II, and all the way to the point where they got into a massive asset bubble which burst in the early 1990s. And then they had what they call the lost decade, right? Now flash forward to the 2000s and 2012, 13, you have Abenomics, where their prime minister came in and he enacted zero interest rate policy to try to spur growth, and basically what they're doing is they were spending so much money and holding interest rates so low because of that deflationary bubble they had gotten into, that they're trying to spur some inflation. And why are they doing that? Because they're issuing so much debt. They have, like you were just talking about, they've got their debt to GDP is only is over 250%. They're holding interest rates artificially low. Now, another thing about Japan that's different than the United States is that they're a net exporter, right? They have a different demographic. They might have a much older demographic. They as a nation, they're savers. They're not spenders like the United States. And so with this zero interest rate policy and their exports, what you're seeing is there's tremendous pressure on their bond market, right? Because as the rest of the world has inflation and is raising their interest rates, Japan is artificially keeping them low. So you've seen over the last year and a half, the United States, if you look at our 10-year treasuries, and those are kind of the benchmarks, you've seen our 10-year treasury go from just a 0.5% or under 0.5% all the way up to 2, 3, 4, and now almost 5%, right? And the same time, Japan was holding their interest rate, their 10-year treasury at 25 basis points and 50 basis points. Now they're trying to keep it under 1%. But as they're holding it down, what happens? Well, if you're an investor in Japan and you've got your money in something that's yielding 25 basis points, yet over here in the United States, you could get something that's yielding 4.5%. Well, what is your choice? You're going to sell this Japanese treasury because you can invest money over here in the United States and get 4.5% rather than just 25 basis points here. So you sell your Japanese treasury, you get yen, you sell the yen, and you buy the US dollar to buy the US treasury. And now you'll hedge that out with a future trade, but in order to get back into the yen. But the whole point is that all that pressure that's building up there, it's called interest rate parity. Investors are searching for yield. They need yield to keep up with inflation. They want yield to grow their assets. So they're looking for that. And that interest rate parity is causing this pressure that's building and building up. in the Japanese Treasury market, where the Japanese government is buying all these bonds because there's no other buyers out there. So the Japanese Treasury is buying the bonds, buying the bonds, buying the bonds to keep the interest rate low, keep buying it to keep the interest rate low. But there's got to be some sort of escape valve for all that pressure. And that escape valve is over here in the yen. So as people sell their bonds to the Japanese government, they get yen, they sell the yen, they buy the dollar. And so you've seen the yen just rise almost, it rises in lockstep with the difference between the US Treasury yield and the Japanese Treasury yield. They rise together. So if you can see, I can share my screen here. I can show you this. I'll show you this chart here, and it shows exactly what I'm talking about. So in this blue line, this is the Japanese yen, and as it goes up, it's getting weaker. That's more yen per dollar. And this white line is the difference between the US Treasury yield and the Japanese Treasury yield on the 10-year. So as that difference goes higher, you get more yield in the United States, the yen gets weaker. And just goes like that all the way through until today, where you're seeing even now the Bank of Japan is holding those interest rates as low as they can, but there's so much pressure here that you're seeing this yen is about to break out again and go even higher, meaning get even weaker. And so that's the issue. That's the mathematical fundamental issue that Japan has. And so it can't go on forever. It will break eventually here. And the Japanese people will be the ones to suffer from it.
Interesting. Yeah. So, I mean, it seems that because, well, I mean, one, the dollar is the world reserve currency. When we inflate the dollar, the rest of the world suffers. And I mean, it to me, it seems like a visual analogy that I have. What the Fed, like all the U.S. government's doing is like putting a ball down in a pool and putting a lot of pressure when they basically print dollars and at the end of the day, they are buying treasuries and reducing basically yields to like a not market driven. And then when they release this ball, it just goes with so much pressure. And it seems that that's happening everywhere. But I mean, like right now, it seems what's happening with US treasuries is that the government's not printing as much money and not like they basically don't have QE, right? And they're not buying treasuries. So the market is actually deciding the price of US treasuries. So yields are going up and they're going up to levels that historically are not that high, but they seem really high because the government's just printing money and, and and just buying it up, and so it's not a market driven thing. But if you look at prices of treasuries, right, like they were at certain prices because yields were at 0%, but when yields go up, the prices of those treasuries go down, right? So like you have banks holding like a lot of treasuries and things like that, and like they are basically, some of them are half of the price that they were before. Like why aren't banks breaking in if they are folding half of that? Like it's just like it's been almost a year and they haven't, like I haven't seen as many bankruptcies. There is the
Yeah.
BTFP. Is
Yeah.
that like what's stopping these banks? Is that so like QE, like mass QE, or I mean, at the end of the day, they're buying out, right? This, like, what's happening there?
Yeah, that's a really good question. And so, and there's a few ways we can look at this. Number one, so those assets that they're holding on their balance sheets, those treasuries, they are impaired in value today. But if they hold them to maturity, they get all their money back. It's okay. No harm, no foul. The problem is they bought all these treasuries way back when the yield in them were so low that now, as the interest rates have gone up, they're worth less and less and less to people because, if it's a 10-year, 20-year, 30-year treasury, then the duration on that is so long that the difference in interest rate that you're getting paid on it, 0.5% or 0.75% versus 4 or 5%, it compounds over all those years. So you have a great loss on your balance sheet. Now, if you hold that until maturity, you'll get that principal back, right? You'll get 100% of that back. Now it'll be worth less in terms of real dollars because now the interest rate has been high for so long that we've had inflation. The $1 million you put in that bond 2 years ago is not going to be worth the $1 million that you put into it in 20 or 30 years. It's going to be worth a fraction of that. And that's essentially the issue. Now, why are they not breaking? Well, the only reason they need to sell those treasuries is in order to have cash on their balance sheet to meet obligations. So if they have enough cash, they don't need to sell those. And so where do they get that cash? Well, primarily from customer deposits. So we saw back in the fall, Silicon Valley Bank, you had depositors get wind that, Silicon Valley has all these really bad investments in treasuries. They don't have enough cash to make payments. I got to get my money out before they go bankrupt, right? And so that's what's called a run of the bank. All right. So the US Treasury and Fed instituted a program called the BTFP, the Bank Term Funding Program, where a bank can take their bonds or treasuries, they can deposit them at the Fed and get 100% of principal back on those and use that cash for a whole year. And that's coming up in the spring. They'll probably extend it. I don't see them not extending it. And I mean, if you it that program has gotten to be pretty large. It's over $1 trillion now, I believe. And so it just skyrocketed. And I can share the screen here. I'll show you, but it skyrocketed, and it's right on that in March and April. All these banks took advantage of it. Kind of got paid down a little bit, but now it's just kind of been creeping higher as more banks have to shore up balance sheets because of things like commercial real estate issues. So unless we have a run on a bank, they don't have to sell those treasuries. And you have the bank term funding program, which is, like you said, it's kind of a stealth QE. How? Because they're putting money into the system that's not really there, right? Because they're lending against an asset that's impaired. And they're allowing a bank to use 100% of the underlying value that is not really the market value. And so it's a manipulation of the market in order to allow those banks to have enough capital to keep operating without having to shore up their own balance sheets properly. And so that's what we're seeing now. That's why we're not seeing banks fail. They have the opportunity to go and use this BTFP, the program, and investors realize that, well, the Treasury is going to step in and save any bank anyways, whether or not they have FDIC insurance. And so we're not too worried about it. And what you have seen is a gravitation of deposits out of these banks and into very, very large banks that are called GSIBs, globally systemic important banks, which means that they cannot fail. That means that the sovereigns that they are operating under, those central banks, will ensure that they don't fail. And that's an agreement in the G7 and G20 to keep those banks liquid and operating properly. And so they will make sure that they don't fail. They're too big. That's where the term too big to fail comes in. And so people have moved some assets over to the too big to fail banks like JP Morgan and Citigroup and Wells Fargo, they're considered too big to fail. So they're not, that's where they would rather have their deposits. Now, all that said, you've also seen a gravitation of deposits into something called money markets. And the money markets are really, they're geared to give a better return for investors and depositors than you get in a checking or savings account. And they do that by buying short-term treasuries. And again, this is how this whole charade just keeps going, because now that money is moved into these money market accounts, they're buying short-term treasuries. And so it allows the treasury to just keep issuing debt. But you're seeing them issue debt that's short-term. They're not issuing long-term debt. They're issuing short-term debt because that's where the money is right now. The money is not out there for long-term debt. It's there for the short-term debt. And the only ones who are really, really, really buying, or one of the only ones who are really buying that long-term debt, the longer-term treasuries, are hedge funds who are playing a game of leveraging up a trade, you know, 5, 10, 50 times leverage and hedging it out with futures in order to play that interest rate arbitrage internally there. So it's kind of crazy right now, but that's how this is it just keeps going.
Interesting. Yeah, I wonder if that's what's preventing like more damage. I mean, when they saved the Silicon Valley Bank, I mean, I've seen stats that recessions take 18 months from the start of raising interest rates. So like we are right around there, but it's just surprising to me. Like if you look at the difference between interest rates of like right now and before, why we're not seeing as much damage as I would expect. I mean, there are some numbers that seem to be fudged, like employment and things like that, but it's just surprising to me that we haven't seen more damage, but maybe it's just a question of time. But a question related to the Fed. So, I mean, we're talking about banks, and one of the biggest ones is the central bank, the Fed. And as other banks, it has a balance. It has a balance of, and also pays out to other banks and things like that. And I think you talked a little bit about this, but not maybe in a different way. But it seems that the Fed is insolvent and it holds a lot of assets, right? Like trillions of dollars of assets.
Hmm.
And that amount is just going to increase. And it seems like if you look at BOJ, it might be as much assets as all the other banks combined. And right now it's insolvent when, interest rates go up when they are market driven. Is the Fed insolvent, and what would that mean like right now and even in the future, right? Like when the Fed prints out more money and holds more and more. I mean, I think the Treasury is the one that at the end of the day is printing out money, but for all intent purposes it seems that So is
Yeah.
it insolvent, and what does it mean right now and in the future?
Yeah, if you look at the Fed is supposed to, what they're supposed to do is they're supposed to be creating profits and sending them up to the Treasury. That's what they're supposed to be doing, right? But if you look at the way they've been operating, they've actually been operating in a deficit. So they're losing money every single week. And instead of sending that money up to the Treasury, they're losing hundreds of millions of dollars. And they're but it creates a hole on the Fed balance sheet. And so instead of filling that hole, instead of fixing that problem, what they wind up doing is they call it a deferred asset, saying that, oh, we'll pay that back when we become profitable in the future, right? So in essence, yeah, the Fed right now is insolvent. Why are they insolvent? Well, they're paying this high interest rate on a number of different things, right? They're paying high interest rates on reserves, bank reserves, that the banks put their reserves there and they pay them interest rate on. They pay a high interest rate on the reverse repo, where the banks have these huge banks have massive amounts of cash that they don't know what to do with. So they're getting a treasury like a T-bill like return on that by putting it in what's called the overnight reverse repo market, and the Fed pays them an interest rate on that. And so they're losing money on that versus the treasuries that they bought that they have on their balance sheet that are low interest rate treasuries they bought back in 2020, 2021, and into 2022. They own these treasuries that are not paying them an interest rate that covers the interest rate that they're paying out on the other facilities. And so they're losing money, losing massive amounts of money. So, and that's, so in essence, they are insolvent, but because it's the Fed, they can just keep doing this perpetually and just call this thing a deferred asset and have a big hole in their balance sheet, but not really worry about it.
But I mean, at the end of the day, that's like, let's say, I mean, right now they can call it for asset, right? It was positive and now it's negative. But if if interest rates are market driven, they will always have that negative value, right? Like that must affect the economy somehow. Like that may cause inflation or something like that. Because I mean, it's just like, how is that different from printing out money if you just call it like, I mean, a deferred asset? Is that much different or?
Well, no, it is pretty. It's allowing it's allowing this system to perpetuate on this borrowed money for sure. This leveraged system. That's what it's allowing for. But it's not, the Fed is not a company. It's not really a bank. It's a bank controlled by a manipulation of the money. And so, we're talking about billions and billions of dollars that they owe the Treasury that is just going to remain that hole for, I don't know how they're going to fill this. I don't know how they're going to repair it. But what they will do is, they're losing 60, 70, 80 billion dollars a year on this. This is just, it's symptomatic of the manipulation and the problem. So the Fed, but it's the Fed. They don't have to answer to anybody. They don't have profitable. They're supposed to be profitable to send money back up the Treasury, and it's only hurting the Treasury. So what does that mean? That means the Treasury's not getting the same amount of money that it used to from the Fed. They're not getting any. So they're just going to have to issue more debt. So it's not about printing money, it's about issuing more debt. But that means, and this is getting to your ultimate point, which is that means that there's so much debt, there's so much leverage in the system that if we do have some sort of credit event and breakdown, that the Treasury will have no choice but to step in, push that button on the Fed's balance sheet, put a bunch of money on there, and have the Fed go in and step into the markets and buy treasuries in order to keep that market orderly. Because if it gets disorderly, if it becomes dysfunctional, if the treasury market breaks down, the entire world financial system breaks. And they know this. And so the whole world is in on it. They know that the treasuries they have to remain liquid. And so whatever the treasury has to do, even if it means go in and buy their own treasuries, then by all means do it, because what we don't want to do is have the entire system break. And so that's what will happen when we get a credit event that's big enough, that's systemic enough, that reaches out and it has what we call contagion, whether it's because of a large bank or a large pension fund or some sort of investment fund that blows up and has counterparty risk with other large banks, large pension funds, large investment funds that then topples and creates this domino effect that could reach the far out across the world. That's when they'll step in and say, hold on. Yeah, we understand that you saw that Silicon Valley, you bought some treasuries that aren't worth as much as they used to be, But what we're going to do is we're going to have this program that allows you to shore up your balance sheet. And then we're going to buy you out basically out of bankruptcy. We're going to hand you over to JP Morgan and the vultures. And, you know, but the system won't implode and your depositors will be made whole. And as long as they do that, they can keep it going.
Interesting. So, I mean, we're talking about how the system's levered, and the US is basically leading the way there. And I think Ray Dalio has this video of like the changing world order, and then you have like, you know, the dollar and the euro, and he's basically hinting, oh look, China is the future. And for me, it just seems weird because if you look at the numbers, if you look at the banking system in China, it's all like, it's even worse. Like it looks like
China has its own problems. China is built on real estate investments that are currently imploding. So the average Chinese family has over an 80 or 90% of their wealth tied up in the real estate that they're living in. And so the real estate market imploding on them is a massive reset internal. And we don't even really know what their debt to GDP numbers are, you know, because they're secretive about it. So we don't really know exactly what they have their own issues. Now, I've read that before with Ray talking about how China is rising and will become the new leader of the free world economy. I don't believe that that's true. I do believe that we're having a reset, but I think it's going to be a global reset. I don't think the United States ultimately is dismantled in this round right now. And that means I'm talking about 3, 5, 7, 10 years, 10 or 20 years, 30 years. I don't know where we are. I truly don't know. And I truly don't trust that the United States will be the ultimate leader. It could be, a consortium of leaders, a new consortium. And for me, and for what I see, and for everything that I am trying to teach is understanding the value of hard money. Hard money. This is the important part. In 1971, when President Nixon took us fully off the gold standard and pushed us onto what we call the petrodollar. Well, now that in essence gave the central banks the ability to just print money and create fake productivity, right? And so, but that's changing, and we're seeing it change right now because of the mismanagement of all these sovereign balance sheets and just the absolutely the fiscally irresponsible spending of our politicians. And we know it's the system. I don't blame either party. I blame them both. The system it rewards people in power for bad behavior, and it has for a very long time. And now without hard money to backstop our currencies, then we're at the spot where they can just keep playing with it until it's worthless. And so for me, I see us. I have hope. I have confidence. I'm excited about what the future holds for hopefully me and my children, and that is a, a system that's based on hard money, that's decentralized, that cannot be manipulated, and that's Bitcoin. You know, it used to be gold, but gold has been manipulated now for years and years in the paper markets. It's difficult to transport, it's difficult to audit. It's, you know, there's a lot of counterfeit gold bars and coins, and so it's not easy to verify and to use as an exchange, as a true store of value. The upgrade to that, something for the first time that we've ever discovered, is a trustless counterparty without counterparty risk system, is Bitcoin. And Bitcoin is truly decentralized, and it allows for a true store of value that is hard money that currencies can be attached to eventually. It won't happen overnight, But eventually that's where I believe this whole, where everything has to go. Because the only other option, Giuliano, is a central bank digital currency. And that's evil. And that's controlling people. And that's limiting your choice. It's limiting your ability to live freely. And so the exact opposite of that is Bitcoin. And that's where I'm headed. And that's what I teach about.
Interesting. Yeah, I hold the same view, and I think that we are moving from the US empire to the internet empire, where you
True.
have like a global empire, and you can. It's interesting to me. It seems that, I mean, I lived in different areas in the US. I'm originally from Brazil. Now I'm living in Austin, Texas, and it seems that when the petrodollar benefited a lot the coastal elites,
Mhm.
where the manufacturing jobs went away out of the US because you like the dollar, the structure of the dollar, and how if you're rich in own assets, you can basically inflate that, but also the amount of exports versus imports. The US doesn't export as much, imports a lot, and the main export is the dollar. But when that changes, you have a lot of production in the US, you have more manufacturing in the US. What does, let's say that the fiat system implodes, and then you have, Bitcoin or whatever you have. What does that mean to the US? What does that mean to, we get GDP per capita going down? Like, what does that mean to the US empire? Like, to the day to day lives of people?
Yeah, I don't. So first of all, I don't think that I honestly don't think that we're on the path to the near term to imploding. And the reason for that is because the US is a global reserve asset. So what I believe happens is the US will swallow other currencies whole first. You'll see people fleeing other currencies into the US dollar as safety, right? Because they know that the US dollar is the last, that will be the last one standing. And so they want to at least have their money there. The issue will be getting your money into dollars. So if you're in Venezuela, it's or Argentina, it's not that easy to go get dollars. To get them, you're having to do it through banks that are either not allowing it or they're charging you exorbitant spreads in order to do it. That just doesn't make any sense. So what will happen though is that these other citizens will go into something digital, like some sort of stable coin or Bitcoin, and then either keep it in Bitcoin or turn their money into dollars. So, but developed countries, developed nations, developed areas like, anywhere in Europe, Eastern Europe, Asia, Australia, like those, I could see those eventually folding into the US dollar as this all, like you said, this global standardization takes hold. And unfortunately, that doesn't solve the problem. It still doesn't solve the problem because of what I said before. There will be people who are opting out completely and want to go to decentralized currency. And that decentralized currency is Bitcoin. And they'll hold gold and they'll hold Bitcoin. And Bitcoin's much easier to transport, move around, and get from country to country or go to where you need to go. It's difficult to confiscate. And so that's where the parallel system takes hold, in my opinion. And so instead of an implosion, we have this parallel system that runs. And so eventually, I think what will happen is that Bitcoin becomes that ultimate store of value, and the US dollar, whatever it is, becomes just that global currency. And so that's that's my best guess. But truly, we've never been in this position before. The world has never been on such a global scale where we're all so intertwined globally with the US dollar, the treasuries, the petrodollar, the euro dollars. there's just so much that intertwines every single country now that we've never been on this kind of scale before. So I can tell you what I believe will happen, but that's just my little opinion. And there are probably 100 different scenarios that I haven't even considered that could play out as well. So but I do believe that Ray Dalio is right that we will have a new world order. How that shakes out, I don't know, but it's happening before us and we're watching it.
Interesting. Yeah, I agree with you. And in all the faults of like, I think Bitcoin is like the best money. I do think that crypto has like, as the tech has some benefits, even though Bitcoiners, talk about Bitcoin as the ultimate asset. I think stable coins will be, it's one of the most adopted tech technologies out there because I mean, the IOU at the end of the day of like Circle as a bank or whatever, it, it is what the dollar was before the introduction of the central bank. But eventually you switch to Bitcoin, which is like the best money. Like there's the dollar, which is better than, the Argentinian dollar or whatever. But then you have Bitcoin, which is the best money out there. One last question. We're a little bit out of time. Thank you so much for taking the time. Really, really appreciate. So in terms of asset prices, I mean, we have this transition phase that you mentioned. Maybe the dollar is like eating all these other types of money, but eventually you have the end of that system where, like this fiat system can't last forever. And we've seen with the implosion of like the bubble that was happening in Japan, basically asset prices went down and you had this lost decade in Japan. And that happened before in different like countries. I think Southeast Asia happened in the 70s and we've seen that again and again. We'll probably see it again. Maybe China is happening right now. We'll see. But what happens to asset prices once we hit that inflection point? Are like if interest rates go back to like, market prices, like yields go up, are asset prices going to go down or like my question is, are asset prices overvalued in terms of dollars compared, to other things like Bitcoin? And what do you think?
Yeah, and
Is
so
gonna,
it's kind of a funny thing. I wrote a newsletter about this, a hyperinflation newsletter, and I wrote a thread about it that you can find on my Twitter feed. But basically, remember when you have hyperinflation, people are looking for anything to keep their value of their money. So they'll buy anything to keep. So rather than holding on to that currency that's hyperinflating, they'll buy gold, they'll buy houses, so in those local areas, you'll see physical gold very difficult to get, and the prices will skyrocket locally. And same thing with their real estate; they'll skyrocket at first. Same thing with stocks. In any public stocks or anywhere you can buy commodities, they will skyrocket. Why? Because those will hold their value ultimately over time. And so you'll see people buying these things and holding them. But eventually what happens is that currency washes out. They have a reset. They reset the debt and they basically reset the currency. And so that all comes back to some sort of fair value. But remember, if you don't own any assets, you're hurt by that quite a bit, right? So especially during that time, but it normalizes to a new spot, and then and we've seen it happen over and over and over again. We've seen it happen in Venezuela, Argentina, and Zimbabwe. It's happened many times in the Weimar Republic, where everything gets reset and you get to a new normal and you start over again. So that's typically what happens. So yeah.
awesome. Cool. Where can people find you online if they want to find you on Twitter or your
Yes.
newsletter? Yeah.
Yeah. So my Twitter handle is just at James Lavish. And I write a newsletter called The Informationist. And it's just I take one complicated financial topic and simplify it every single week. It's been great. People have really enjoyed it. I love it. So you can You can find the link to that in my Twitter handle. And yeah, it's grown pretty big to almost 20,000 subscribers now. So it's been a fun experience.
Awesome. Yeah, it's one of the best newsletters out there, if not the best, covering economics. I recommend following James on Twitter as well, or X. It's really worth the time. Thank you so much again for your time. Really appreciate. It was great talking to you. I've learned a lot. I think people will learn a lot. Thank you again.
Awesome. Well, thank you for having me, Giuliano, and I look forward to the next time.
All right. Thank you.